The average American thinks their bank makes money by charging fees. The real number? Fees are just 24% of bank revenue. The other 76% comes from something you do every single day without realizing you're funding it. Banks aren't really in the money storage business. They're in the money rental business. And you're both the warehouse and the supplier. Banks exist in a unique position in the economy. They're middlemen between people who have extra money right now and people who need money right now. A college student with $800 in checking isn't using that cash this instant. A family buying a minivan needs $30,000 today. The bank connects these two situations and charges for the service. This model requires a specific type of permission. When you deposit money, you're entering a contract. The bank doesn't lock your cash in a vault with your name on it. They're allowed to use it. In exchange, they promise you can withdraw it whenever you want. That tension between we're using your money and you can have it back instantly is where the entire system lives. Interest income means revenue from lending. It's the largest profit source for most banks. Here's the mechanical flow. You deposit $5,000 in a savings account. The bank pays you 0.5% annual interest. That's $25 per year. Meanwhile, they loan $4,500 of your deposit to someone buying a car at 6% annual interest. That generates $270 per year. The difference between what they pay you and what they earn from lending is called net interest margin. In this case, $245. Think of it like a rental arbitrage situation. Someone subleases an apartment for $2,000 per month while paying the landlord $1,400. The $600 gap is their income. Banks do this with money instead of real estate. The specific percentages shift constantly. When the Federal Reserve changes baseline interest rates, banks adjust what they charge borrowers and pay depositors. But the spread, the gap between the two, tends to stay relatively stable. A typical net interest margin sits between 2.5% and 3.5% for most commercial banks. Now, the critical multiplier: banks don't lend just your $5,000. They combine your deposit with millions of other deposits. If a bank holds $10 billion in total deposits and maintains a 10% reserve, they can lend out $9 billion. At a 3% net margin, that's $270 million in annual interest income from the spread alone. The actual math gets more complex due to reserve requirements. Banks must hold a percentage of deposits as reserves, either as cash in the vault or as deposits at the Federal Reserve. The current requirement fluctuates, but let's use 10% as an example number. That means for every $100 deposited, the bank can lend $90. That $10 stays liquid to cover withdrawals. This creates a strange reality. If every customer tried to withdraw their full balance simultaneously, the bank couldn't pay them. The money is out on loan. This is called a bank run, and it's why deposit insurance exists. The FDIC guarantees deposits up to $250,000 per account, which prevents panic withdrawals. Fees come in dozens of forms. Overdraft fees hit when you spend more than your account balance. ATM fees charge for using another bank's machine. Monthly maintenance fees apply if your balance drops below a threshold. Wire transfer fees. Cashier's check fees. Paper statement fees. Account closure fees. The mechanics are straightforward. These services cost the bank almost nothing to provide. Processing an overdraft transaction takes the same computer resources as processing a normal transaction, fractions of a cent. But the overdraft fee averages $35. The ratio between cost and charge is where the profit lives. Fee income used to contribute much more to bank revenue. In 2009, overdraft fees alone generated $37.1 billion across the industry. Regulatory changes capped some fees and required opt-in consent for overdraft protection. By 2020, overdraft revenue dropped to around $12 billion. Banks responded by increasing other fees and raising minimum balance requirements. Here's a common confusion point: free checking accounts. The word free refers to monthly maintenance fees. You won't pay a recurring charge just for having the account open. But overdraft fees, ATM fees, wire transfer fees, and minimum balance penalties still apply. The average American with a free checking account pays around $170 per year in various fees. Some fee structures work as penalty systems. If your balance drops below $1,500, you pay $12 per month. This charges people for not having enough money, a regressive design where cost burden falls heaviest on those with the least financial cushion. This is the piece that changes how the whole system looks. Your deposit isn't just sitting there earning the bank a percentage. It's functioning as legal permission to create loanable funds. Banking regulations define how much a bank can lend based on how much they hold in deposits. A simplified version, $1 billion in deposits allows roughly $900 million in loans. More deposits mean more lending capacity. More lending capacity means more interest income. This is why banks advertise aggressively for new checking accounts. They're not trying to collect $12 monthly maintenance fees from you. They're trying to expand their deposit base so they can legally increase their loan portfolio. A customer who deposits $50,000 and never pays a single fee is still valuable. That deposit justifies $45,000 in additional lending capacity. The term for this is low-cost deposits. Banks distinguish between money they acquire cheaply, like checking accounts paying 0.01% interest, and money they acquire expensively, like promotional savings accounts paying 4%. The cheaper the deposit, the wider the net interest margin when they lend it out. There's also a timing advantage. Loans lock in interest rates for years. A 30-year mortgage at 6.5% means the bank earns that rate for 3 decades. But deposits are short-term. If rates drop, the bank can lower what they pay depositors almost immediately. If rates rise, they're still earning 6.5% on all those old mortgages, while only slightly increasing deposit rates. This asymmetry creates profit during rate fluctuations. Misconception 1. Banks make most of their money from fees. Reality: interest income typically accounts for 75 to 80% of revenue at traditional banks. Fees matter, but the lending spread is the core business. Misconception 2. Your deposit just sits in the bank. Reality: only about 10% stays as reserves. The rest is loaned out immediately. You have a claim on that money, but the physical dollars are elsewhere. Misconception 3. Banks lend out other people's money. Technically true, but incomplete. Banks create loans based on their deposit base, but accounting rules let them create the loan first and find the funding after. It's more circular than a simple take from A, give to B model. The simple story assumes stable conditions. It breaks during bank runs, when mass withdrawals force banks to call in loans or sell assets at losses. It breaks during credit crises, when borrowers default and the bank doesn't receive expected interest payments. It breaks when interest rate curves invert, when short-term rates exceed long-term rates, because banks typically borrow short and lend long. Smaller banks face deposit concentration risk. If one large commercial customer pulls $40 million, it can destabilize the entire institution. Larger banks have more diversified deposit bases, which smooths out this risk. The 2023 bank failures illustrated a specific edge case. Banks bought long-term bonds when rates were low. When rates rose, those bonds lost market value. If the bank needed to sell them to cover withdrawals, they'd realize losses. Silicon Valley Bank collapsed partially because their depositors were concentrated in the tech industry. When that sector hit turbulence simultaneously, mass withdrawals forced asset sales at a loss. Banks make money by paying you less for deposits than they charge for loans. That spread generates the majority of revenue. Fees add supplemental income with minimal cost. And your deposit itself functions as the legal foundation that allows all the lending to happen. You're not really the customer in the traditional sense. You're the supplier of raw material. The bank's product is loans, and your deposit makes those loans possible. This isn't exploitative, it's just the structural design. Understanding the mechanics shows you where your money actually goes when it sits in an account. It's working, just not primarily for you.